Do we see hype in terms of valuations of the companies, in terms of multiples? Do we see a bubble that is forming? Is this bubble going to pop?
Sure.
So this is something that is very interesting for me, probably for our audience as well.
Sure. Yes, and you probably guessed it. This is the most voted answer of our short quiz online, and this is our new mini series. You ask, we reply, no bullshit. So whether valuations are hype now or not, to be honest, I've been scratching my head about the valuation topic for about 16, 17 years. It's getting really philosophical already. Because conventional finance, traditional finance, they teach us that the value of the company is derived from the discounted free cash flow, and for young companies, this figure is usually negative. So as tech investors, we should find a shortcut in order to value these companies, and this shortcut is usually represented in the revenue multiple nowadays. At first it seems that it's a simple figure, but it can get quite complex, what stays behind this figure, because in the end of the day it boils down to two questions for me that are kind of interconnected. The first question is for how long the company can stay in this hyper-growth mode, what's the runway of growth, and the second question is in the end, when this growth slows down, what are the long-term margin structure for these companies. And nowadays we hear companies raising money at 50, 70 or trading at 80 times the revenue, and we say, oh, that's crazy or nonsense or something like that. But as a VC investor, you usually take a different perspective, because you try to work with a normalized revenue multiple, looking ahead 2-3 years ahead, right? If these companies are growing at 200% or 150% per year for about 3 years, the revenue multiple is going to be significantly lower, right? So what I'm trying to say is that you usually have a period of, 24 months where you're in the dead zone, dead money. But after that, if the company remains in the hyper-growth zone and it's growing about 70-60% per annum, you see your money start compounding, and that's pretty okay. So it's really important that the company remains for as long as possible in this hyper-growth stage, and you have to analyze and assess this. And the other thing is that in the end, especially in the software industry nowadays, which is a relatively young industry, companies are operating at very high margins, gross margins of 70 to 90%. And now we see with some of the older software companies that they operate at stable free cash flow margins about 30%, which is a lot, and it requires higher multiple. So from that perspective, it's not about hype. But what I see in public markets is also that good companies that are outperforming, they're very high priced, and average performance, they are being hammered. So it's that's rational. That's rational in a sense. But what I see in the private market, in venture capital world, is that founders they start practicing revenue multiple comparison, right? So if the founder next door receive investment at 50% revenue, I should receive the same multiple. No, that's totally wrong, and that's hype, and we should be aware of this.
Yeah, so that is very insightful, actually. That's very insightful, and for me, this kind of analysis and explanation kind of covers more or less the rational part of it. But let's not also forget that at the moment, all central banks are pumping trillions into the system in the economy. This means cheap money for the funds, for their LPs, because they are hunting for a return. And thus, these guys have very cheap available resources to invest. we as a species are quite greedy. We want to get rich, we want to have resources. So the fear of missing out is also there, and this is how our psychology works. At the moment, everybody wants to get into a certain, for example, category. They don't want to miss it. They want to invest in this company. They just don't want to kind of to miss all these opportunities, and the cheap money kind of accelerates that. So this is another side of the, let's say it was what Alex told us was the rational side of it, and I was kind of, I'm always thinking about as well as the irrational way of making decisions, and I think this is valid for throughout the entire spectrum of life, not only about investing as well.